What up, doe? It's Langston Hughes and welcome back to the channel. Today we're going to discuss Japanese candlesticks. And like anything we desire to master in life, we have to learn its language and its text. The language of the charts is candlesticks. You'll soon discover that the charts are filled with a thrilling story, poetry, and price, an epic of the bulls versus the bears. With that being said, let's begin and uncover the tale of price.
Fingers down my spine. Girl, you look mighty fine. Won't you rub your fingers down my spine? Girl, you look mighty fine. Won't you rub your fingers down my spine?
Japanese candlesticks, or simply known as chart candles, are believed to originate in Japan, developed by an 18th century Japanese rice merchant named Munehisa Homa. Around 1710, a future market emerged for rice, which previously was only traded on the spot. This new system used coupons promising delivery of rice at a future date. With this new value seen in coupons, all the hustlers saw a huge opportunity. As a result of this new market, a secondary market of coupon trading emerged, in which Munehisa Homa reigned supreme. He was top dog. He was able to establish a personal network of men about every 4 miles to communicate market prices, allowing him to monopolize on a new booming coupon market. Homa is also the first to write a book on market psychology known as The Fountain of Gold, the Three-Monkey Record of Money. In this literary piece, he claims that the psychological aspect of the market is critical to trading success, and that traders' emotions have a significant influence on the price of rice, stating that recognizing this can enable one to take a position against the market. When all is bearish, there is cause for prices to rise, and vice versa. When all is bullish, there is cause for prices to fall. He further described the rotation of yang, a bull market, and yen, a bear market, and claims that within each type of market is an instance of the other type. In modern times, Japanese candlesticks were first introduced to the Western world by Steve Nissen, who famously authored Japanese Candlesticks Charting Techniques. Okay, enough with the history, let's get to the nitty-gritty. We'll begin with the anatomy of a candle. There's 6 main attributes. Number 1, the open. Number 2, the close. Number 3, the high. Number 4, the low. Number 5, the color. And number 6, the lifespan. We'll focus on the first 5 and take a deeper look at lifespan later. 1 and 2 represents the body. 3 and 4 represents the wicks. And 5 represents the color, whether it's bull or bear. So 1 and 2, open and close, will make what is known as the body. 3 and 4, or high and low, will make what we call wicks. These wicks details where price has traveled, known as range. However, the wicks do not tell us where price is opened or closed. Only the body can determine that. And number 5, color. Color will indicate whether the candle is bullish or bearish. Traditionally, white candles indicated a bull candle and black candles indicated a bear candle. Today, green candles commonly indicate a bull candle and red candles indicate a bear candle. Aside from color, there's one other way to determine if a candle is bull or bear. That's by looking at the open and the close. If the open of the candle is at the bottom and the candle closed above the open, then this is a bull candle because price opened below here and closed above. And vice versa. If the open of the candle happens to be at the top and price closed below the open, then the candle is bear because price opened above and closed below. Anatomy of a bull candle. Open and close will be determined by the body of the candlestick. Wicks will determine where price traveled. From open to low to high to close. So, in the lifespan of a candle, the candle begins at the open for a bullish candle. Goes all the way down to the low. Coming back up, creating a wick, and now flipping colors to green, which is the common bullish color, continuing traveling all the way up to create the high of the candle, before coming back down to the close, completing the body of a candle and also showing traders where price has closed. Anatomy of a bear candle. Open and close will be determined by the body of the candlestick. Wicks will determine where price has traveled, from open to high to low to close. So let's take a look at the lifespan of a bear candle. It begins here at the open, travels all the way up to the high, blue in color first, comes back down as it's rejecting the high and creating a wick that follows its trail, now flipping color to commonly red as the bearish color, coming all the way down to reject at the low, pushing back up, leaving a wick until it finally reaches its closing point, where price will close, creating a bearish candle, red in color. The wicks are literally just an indication and a footprint of where price has traveled, from the high to the low, from the low to the high. The trail that it leaves behind is known as the wick. The lifespan of a candle is determined by the time frame. Once that time frame has been completed, a new candle will be printed. Popular time frames range from monthly, weekly, daily, 4-hour, 1 hour, 30-minute, 15-minute, 5-minute, 1 minute, and even seconds. And do you remember how Munehisa Homma said, within each type of market is the instance of the other type? And the same goes for candles. Within each candle time frame is the instance of every other candle time frame. For example, the daily candle makes up an entire day. It opens at the day's beginning and closes at the day's end. After one day, a new candle will be printed. It's made up of 24 1-hour candles because there's 24 hours in a day. We could even say that it's made up of 6 4-hour candles because 6 times 4 equals 24. And the 4-hour candle is made up of 4 1-hour candles. And the 1-hour candle is made up of 2 30-minute candles. And the 30-minute candle is made up of 2 15-minute candles. And the 15-minute candle is made up of 3 5-minute candles. And the 5-minute candle is made up of 5 1-minute candles, and so on. You get the point. Within each candle time frame is an instance of every time frame. And here's an example, 2 30-minute candles making up a 1-hour candle. You have the 30-minute open here, came down to touch the low, traveled all the way up to reject at the high, came back down and closed where it closed. Bullish, green. The next 30-minute candle opened up here, came all the way up to test the high, came back down a bit to test the low of this candle, came back up and closed. And this is representation of the 1-hour candle. That's the first step to unveiling the story that charts have to tell. In the next video, we'll look at other components that create the epic of the bulls versus the bears. If you enjoyed this video, don't forget to like, subscribe, and comment. Please do let me know if this video was helpful for you. And until next time, peace.